Good afternoon, everybody. It is Monday, October 12th, 2020. 3 days left to get your taxes in without getting a penalty. Some of us have a little spreadsheeting and Schedule C to do tonight. So I made a couple of updates. I've been working on fundamental trends at the request of subscribers. I used to have the articles broken up by ETF, option, stock, that sort of thing. I broke it up by type of subscription you have now. So if you're Global Trends ETF, you're going to get all your Global Trends ETF right here. If you're Sustainable Growth, you'll get all your growth stocks right here. Very easy to read member content. They also pop up on the front page, although you may not have access to everything that's here. For example, Global Trends ETF would not have access to the stocks article. So I thought I'd give you that update for all of you who are a member there. Very easy now to get to your member content. There's a lot of overlap right now because of the way I had to switch the categories and the articles. So really, most of you are getting almost of everything that's old, and going forward, you'll only get what you're subscribed to. So the archives are pretty much available to everybody. Today's article, I wrote the good till cancel buy orders, and I want to walk through how to use this. I know that we've been looking at talking about REITs today, and I'll talk about one at the end here. But I've been going through just tons of material about the REITs, and I know that most folks just want to say, oh, this one's low, this one's that, this one's that. Not me. I'm looking at their actual properties. I want to know what the properties are that they own. I want to understand exactly how their rents work, what exactly their risk is. For example, one of the REIT guys was talking about Enbridge, which he doesn't understand in the least, saying that it's kind of like a REIT, and as long as oil prices don't stay low, they should probably be okay, and had it marked as a strong buy. I'll tell you what, Enbridge is going to keep going down in price. They're going to have to cut their dividend. They don't have any ability to grow, and they're going to start losing a lot of their tolls. So, there's that. You don't want to be an Enbridge or any oil pipeline. The only pipelines worthwhile are what? Natural gas pipelines. Why? Because natural gas is going to be used until past 2050. Oil, we already had peak oil demand. We'll probably touch it again, maybe break it by 1 or 2%. But oil is going to start going down for demand by the end of this decade. It is clear. Anybody who argues with that is just arguing for the sake of arguing. Oil demand will be going down by the end of the decade, and that will kill a lot of oil players, from the pipelines to the producers, to the majors, to the miners, to the frackers, to the other-ers. That said, let's talk about ETFs. Put out the buy orders today, and I want you to understand how this works. Put a little intro to the article just for some of the newer folks, where to find various topics. You're getting started are at the top. Resources over here. Managing good till cancel orders. A little step-by-step approach. Determine the prices that you would like to buy the ETF at. And the way I do it, and you don't have to do the exact same percentages I do, is I set 2 orders for 1/3 of my position. Now, you can do all 3 orders, right? Because there's 3 prices that I set, but I don't do all 3 orders at once. The reason I don't do all 3 orders at once is because the first order, the one with the highest price for good till cancel, I may or may not use. If I use it, that's great. It's a starter position, 1/3 of the money that I might get invested into a position. But if I don't use it, I just change the date and the price, and I make it the 3rd order. So I could change the first order to the second order, first order to the third order. Now, you can put all 3 orders in, 1/3, 1/3, 1/3 at 3 different prices. In this case, I think it was 240, 220, 200, or 180, something like that. but there's 3 buy prices that I have on here, and you could put in 1/3, 1/3, 1/3. I typically put in 1/3 and 1/3, or 1/3 and even 2/3, because if momentum is going down hard when it gets to here, then I'll just change this order to become this order. So I'll just change the good till cancel price from 240 down to say 180, and then my primary order becomes the one that's at 220. That easy enough to understand? So create your good till cancel orders. You can do it at 1/3, 1/3, 1/3. I typically do, 1/3 and 1/3, or 1/3 and 2/3. Depends on how I feel about this price. If I really want to be in at this price, I'll make it 2/3. And if you could do something else with your money, if you wanted to, like 20%, 40%, 40%, you could do that. But I've always found that just flipping the thirds around works pretty easy. So you can click on here and see the chart at TradingView. I describe how to get in to all of these. I give an example, and then I get down to the nitty gritty, and we have the different scale and prices. So again, looking at QQQ, you could set up 3 orders at 239, 221, and 180 if you wanted to. And then if momentum down is really heavy as it gets towards 239, you can cancel this, and then you go and change one of these orders or both of these orders to buy more. Does anybody not follow? Pretty simple. You just may not actually make this trade here if the downward momentum is real heavy. You'll move it over here, all right? So we went through all of these. I did add a fund. We've talked about this one in the past. I really didn't engage in it, but we want emerging markets exposure. And for those of you who really don't want to use the country funds just because they're a little bit more to manage, although I tell you what, getting these at the right prices, these are good 50% movers often. So these are great position trades if you have the gumption to do it. So in any case, we do want some emerging markets exposure, but we want to be in the part of the emerging markets that's growing, and this is where the money is being made. So if we can get this on a pullback, see this level here, it's probably the highest I would pay. And then if it breaks through, this is another support level, and then we have big support down here. So this is a pretty easy one for a buy, another buy, another buy. But then again, you just cancel this buy if the downward momentum is super heavy, and you move it down here or down here. I would like to show you. So if we go to do just pretty simple screening, pretty easy to see who the winners are, right? And one of the things that we should have been learning over and over and over again is the old Will Rogers thing: invest in things that go up. So, we take a look at these, and I did take a look at this one, but it's pretty thinly traded. This one has over $1 billion in it, right? Or right around $1 billion in it, which is generally what I'm looking for. So it's got some options, I believe. This is a pretty easy one to buy. Year to date, it's a leader. It's more diversified than any of the China stuff. There are other funds here that look fairly attractive in emerging markets, but the difference from internet and e-commerce to some of the others is just pretty massive. So unless you're going to do the country funds, I think that this Wisdom Tree Hedged International Dividend Growth, which is a leader in its category, and this one are probably the way to go. That gets you huge exposure. Developed markets. We need to go ex-US. I wish I hadn't closed this because I had it all set up. That's my fault. This Wisdom Tree fund here is essentially similar to the one that we're using. And if I do the search right, it does end up popping up right on top. Now, since we're just looking at global funds here, one thing to see is that clearly the clean energy is a big deal. Internet is a big deal. So these are the types of things we want to look at. GDX and GDXJ are on this list. Really we're looking for winners. And I think that the themes on the barbell are going to remain the same for a while. There's probably some things that we can find at the very start of a run-up, and that'll be interesting for us. Let's see if I can find a way to find the other way that I had that up. Well, whatever. There was this fund showed up at the top of a bunch of screens, and apparently I forgot how to do it. And I don't like that these boxes are so little. In any case, this is one of the screeners I've been using. Oh, I know what I can do. Structure, no leverage. That was one of the criteria. And somebody asked me about buy right strategies. Yeah, they all suck. They all suck. This is the only one that's even close to being okay. This Global X. It's not good. I mean, look at it year to date, right? This has the same problem that I had, or that I have about to expire. We wrote covered calls and capped our gains in a raging bull market. That's the same thing that happened here. So you'd think a NASDAQ 100 fund would be up 10 to 20%, right? But they wrote covered calls and they kept getting called away. And then you have a dead period of time while you wait to get called away. Or you have to pay money to free up your money, and now all of a sudden you're 3, 4, 5% behind in that. So you're trading time for money. Oh, let's see here. I don't see it. I looked in the history. There's so many that I don't know. I know it was something along developed markets line. I'll get rid of this buy right. So in any case, you can see that some of the funds that we've talked about, iClean we had a while back, semiconductors, even though we're using a different semiconductors, clean energy, ARC innovation stuff. So we're on the right track with the ETFs that we're looking at. It's just you can really split hairs. You could trade a lot of these, I suppose, if you wanted to. Will Invesco Solar go up 250% again in the next couple of years? I don't think so. That's one of the reasons that I moved to a more expansive ETF. So PBW and PBD are fairly similar. You see how well that's done. All right. So any questions about this? No? Okay. Somebody asked, should we keep trimming on the rise of the market? Well, I did a whole webinar on that on Friday. So, what would have changed between Friday and today? Right? There's nothing that would have changed. Market went up. It's going through this last resistance level before it gets to the giant trend line. It's going to take a lot of juice to get through this trend line. And in today's article, I showed how the options are working. So if you take a look at these charts, I mean, what does this look like? This is the small trader put to call premium, right? Put premiums are just incredibly cheap. Calls are expensive. You should read this, right? The market makers are making the price of calls more and more expensive. So if you have holdings that you'd prefer not to sell, right now is the most amazing time to sell covered calls because they're god-awful expensive. So go ahead and do it. You could probably write them right at the money. And the millennials just keep on buying calls. I mean, just look. Every time there's a setback, they just load right back up. But look, it's a little bit lower now. And there's been a little bit of jitterbugging on the puts. Do you know why? It's about time I showed you this. Over at Reddit, the kids are talking about buying puts. There you go. And now the influencers are talking about buying puts. And they use colorful language. But you can go all the way down here. What you find, you just go in the last month, more and more talk about puts among the millennial traders. Some good ideas, some bad ideas, but they're figuring it out. So I don't think that the juice that the millennial traders have put into the market are likely to carry this market much longer. In fact, everybody wants to say, well, it was SoftBank that put $4 billion into calls. But really, that's dwarfed. There was $40 billion by the small traders. The small traders are the ones that have been moving this market. I've been telling you for 2 or 3 years now that the traders are gaining more and more power. Just shoots up, right? Retail trades. Triple the number of retail trades in a year. At the margins in any industry, think about your industry, at the margins is where prices change. So what if a handful of these influencers start talking about buying puts and getting out of calls on Friday when the calls expire? What if they're taking profits this week and shifting into buying puts? The same dynamic that pushed up the price of stocks by retail investors buying calls, which forces market makers to buy stocks, could be flipped over. Retail investors could buy puts, and that'll force market makers to sell stocks. Now, I don't think that we're going to see lows again, right? I don't think we're going to see down here again unless there's some other event. But we for sure can get down into here, and maybe even in here, but somewhere between here and here, just on a change in sentiment among millennial investors. Then as they push prices down 10 to 20%, then they'll say, okay, I'm ready to buy Google and Amazon and Roku and Square and everything else again. And then they'll trade it the other way because they know the megaphone is over here. And they probably don't have the juice to get it through the megaphone line, but they can keep bouncing it, keep bouncing it up. So we have to decide at what point is the dip big enough for us to buy. And that's what all these buy zones are about. These Fibonacci lines become important because so many traders use them. They become self-fulfilling. The same way market makers buying or selling become self-fulfilling because of the options buying. I encourage you to browse Wall Street Bets. Oh, somebody responded to my message. Let's see what they had to say. There's people reaching on Seeking Alpha because they're smart. Fair enough. This guy has -7 karma points. So just so you understand what that means is he's got more people that hate what he says than like. Oh, same guy. All right. I do think this is an expansion of the article that I wrote for us, right? Ready with your bucket. This is an expansion of the part about the millennials. So you go ahead and read that. I think it's what should help you understand, especially if you follow some of the links, that the millennials are the marginal trade. As they go, so goes the market until somebody pulls the rug out from under them, which I think will end up being the hedge funds unless the millennials pile on. And as I say in this article, I believe that the hedge funds are feeding these traders ideas. So they may just have this little minion army behind them pushing things up and down for them. So the hedge funds have, had a great year. And I think a lot of it has to do with manipulating traders. Somebody asks, boomers have 60% of total wealth. Millennials have actually 4.6%. How can millennials impact the market? I just told you. They're using calls and they're using margin. Boomers are in net withdrawal, just about, right? Are the boomers putting money into stocks anymore? I've showed you, right? Where's the last article? I had it in the last article. The millennials are buyers. The boomers are sellers, correct? Are boomers buying stocks anymore? No, not really. They're about net neutral. They don't count anymore. They don't count. They only count when they buy or sell. They don't count for just sitting there. So think about it like the housing market. There's a house sitting there. Nobody wants to buy it. Price drifts down. 2 people want to buy it. Price is pretty firm. 3 people want to buy it, and one of them's got a cash offer and willing to go above the market price or the asking price. Price goes up. Prices on every product in the universe, including stocks, are driven by marginal demand. Your house doesn't go up because it's more valuable. It goes up in price because somebody really wants it today. That's why commodities, when they're abundant, go down in price. At the margin, they can't sell them all. When commodities are in shortage at the margin, everybody wants the last one. It doesn't matter that the boomers have more money. They are not participating in this market right now. And if the market starts to drop, the baby boomers are going to start selling because they're going to be scared. They did it in 2008. They did it in 2001. It's just the way it is. I'm going to tell you something. The baby boomers have been remarkably bad investors for a very long time. They have money because the United States of America for 40 years has been borrowing over about $1 trillion a year. We've borrowed $34 trillion since 1981, federal debt plus the Fed balance sheet, and we have outstanding obligations that we haven't funded for the boomer retirement of pushing $100 trillion. So by not saving for the future to pay their own retirement benefits and borrowing another $34 trillion, I mean, we're looking at real obligations for this country over the next 30 years of about $130 or $140 trillion. And after the next set of stimulus, it'll be $150 trillion. That's where the boomers got their money. They borrowed it from everybody that was born after them for 40 years. And one of the points that I make in this millennial article, to go back here, is that the millennials are fully aware of this. Now, I'm not saying that a lot of boomers didn't work their ass off, but I'm saying that financially, on whole, when you have 75% of a generation broke at retirement, they weren't real responsible. As the name Robin Hood implies, the millennial traders are learning how to take from the rich, or at least richer than them. They're not waiting for their inheritance. They're asking for more money at work, and you all know this. The millennials ask for more money at work. Every 2 or 3 years, they look for a raise. If they can't get it where they are, they switch jobs. And at younger ages, they are learning what the market is all about. Now, they may want Medicare for all, but I will tell you this, that's just a pragmatic thing. They're better at the stock market than most boomers. And you need to be aware of that because they're coming for you. And one of the points I make at the very bottom of this article, and we've talked about it with the barbell, but I'll put it into a different context. You have to invest like a millennial going forward because they are the marginal money. You can't say, well, I like this stock because it's a value. If the millennials aren't going to buy it, the stock price will never go up. And for most of us, unless you're going to get into private equity, you can't take that company private to get a piece of the profits. So there are an awful lot of companies out there that are never, ever going to go up in price because the millennials won't buy them. You need to understand what the millennials are doing. Their share of the market of net worth in this country went from 3.2% to 4.6% in 1 year. It's a 40% increase. The boomers' share of net worth went down, just by a little, but it went down. Keep that in mind. Boomer wealth is starting to decrease slowly, but it's starting to decrease. And if there's a market route, there's a winner and loser on every trade. And I'm just telling you that the millennials are probably going to be in the winning camp more often than not because they control the marginal money. Now, the hedge funds could screw everybody. Yeah, I'm sure they'll try. But the reality is that the millennials control this market. Now, is there going to be a fight over the market for the next several years? Yeah, probably. In the end, the millennials will win. They have history on their side. Why? Because they're younger and their incomes are going up versus the boomers who are starting to retire and their incomes are going down. It's just a natural order of things. And it's here sooner than I thought it would be. But COVID, it accelerated a lot of things. It accelerated the work from home economy. It accelerated the shift to e-commerce and fintech. Why would this be any different? That's why the millennials control the market now and not the boomers. So I'll take a look at one stock because you're going to get an opportunity to buy this. The Trump administration, in its infinite wisdom to keep doing stupid things right up to the very end, is trying to put pressure on solar prices by repealing an exemption to the tariffs. So the solar stocks all got the crap kicked out of them today. I don't think this lasts too long. But SunPower also made some announcements about selling some stock and and refinancing some things and getting out of debt. And they're going to issue some shares to do it. This might be your last chance coming up to get this stock for around 10 or 12 bucks a share. So you need to be aware. I have already set cash secured puts, $12 cash secured puts for December, and I have a strike price of $3. Right now they're trading for about $1.25. So I need this to come down about $2 a share, right, to 15-ish, and then my puts will all sell. And that'll make me, like a 20% gain by the end of the year. Unless it goes down below 12, and then the shares are put to me, which I'm fine with. I want those shares if I can get them, with a net price of about $9. And I might, if the momentum down stops, I might just change it to a market order and take whatever price they give me, $2.50, whatever it is. But SunPower had two things happen. Trump administration screwing with the tariffs, and they're basically paying off their debts of 2021 and 2023 by issuing some shares and selling their Enphase stock, which they paid a shit ton of money on. So SunPower is going to come out of this just really strong, dropping all kinds of money to the bottom line. This might be the very best stock for you to buy going into a Biden presidency if you can get it to come back down into this yellow zone. And I think you're going to get it under 15. If you don't own any, buy a couple shares at 15, sell some of the $12 cash secured puts, or just set limit orders and do it like we talked about with the ETFs, 1/3, 1/3, 1/3, 10, 12, 15. And if the momentum down is real hard here, switch this one down to 10 or 12. REITs, I just want to show you one REIT, and I want to explain to you why it's an awesome REIT. And I've looked at 50 of them, give or take, in the last month. I don't remember exactly when Buffett bought this stock. I know when I did. I talked about this 3 years ago, about the same time. So I was April, he was June, or was I August? I was August. So Buffett bought it, and then I started talking about it. I don't remember if I stole the idea from him or not. I think I actually discovered this company down in Arizona. Buffett bought more of the stock in here, probably right about here, maybe down here. We don't know yet. Yeah, it sounds like it must have been in here. We'll see the Schedule F soon. Or maybe it's already out there. In any case, he owns about 10% of the company now. And I'm going to talk to you about this company again. Strip malls, the big stores, not your little, 500 square foot places. This is where Michael's is. This is where Ulta is, that sort of thing. And they pay a good dividend. They haven't gotten rid of it. And it's right at the spot where I kind of indicated it would break out. So you need to use market weakness to get into this. Can you get it around 26? I already own this stock for about almost 2% of my holdings. And my average cost is about $27.80 because I bought it back in here. My limit orders are at 26 because I already own some. But I think that you can pretty much be buying it on any down day right now, this week, because this stock's going back up to 50, into the 40s, and then it's going to go way up here. Why? Because their rents are really good, and their properties are really easy to take care of, and they're really geographically set up great. There's nothing about this company with their triple net leases that they're not going to win at. Now, they had about 40% of their rents not paid at the very start of coronavirus. And all those rents, except for the companies that go out of business, are going to get paid over time. There's going to be rent mitigations, I'm sure. They're going to have to work with their tenants. So I would anticipate that they don't collect all that money. And when you consider time value, they won't collect all that money. So any dip in here on the market correction you're going to want. I think it can get back into the lower 20s on a weak market. And if it does get down to this range right here, just buy the stock. Okay. Again, we should have bought it down here, but I was a little afraid they might go bankrupt. They withstood it. The economy's not going to get worse right? After sometime early next year. Now, somebody did send me something from UBS today, and I won't throw her under the bus, but UBS is full of crap. They were talking about herd immunity by next summer. Mathematically, it's impossible to have it that quick. And second, it might be impossible to have herd immunity altogether because our antibodies don't seem to last that long with COVID. People are getting reinfected after 3 months, 4 months. Now, I think those are the people who have maybe weaker immune systems. However, the antibodies don't seem to last forever. So this is going to be something that we're dealing with for several years until everybody's inoculated, which probably doesn't happen until the end of next year if Merck succeeds or some of the other vaccine places succeed. Now, Merck with the spray in the nose, somebody mentioned that on Friday. I think that's going to be pretty interesting to watch. So again, Merck on a dip. This is your dark horse to win the vaccine war long term. If you're a retiree and you want, a great blue chip healthcare company, if you can get Merck around 70, right in here, you need to buy it because not only will you get the dividend, but they might create, because I think this virus is worse than people still realize, they might create a very long-term source of major, major revenue. Not because they're going to sell it for a lot, just because they're going to sell it a lot, right? The price might not be very high, but McDonald's made a lot of money selling burgers too. So I like Merck down around 70. I think you should too. Please read this article and think it through and understand what I'm trying to tell you. The day is gone that you can invest in just something because, I think that's a good business and it's a good value and, it was higher before, so maybe it'll go higher again. Bullshit. If it's a zombie, it's a zombie. It's just dying slower. Just waiting for somebody to put a stake through its heart. Silver bullet. I don't know. Whatever officially kills zombies. Are they allergic to garlic too? I don't know. The millennials control the market. They're going to control it more and more and more. You have to get with the barbell. If you don't get with the barbell, you are in trouble. That one. All right. I'm not loaded for pictures right now. This is what the millennials invest in. Growth, and clearly they have some interest in real estate and gold and crypto, certain materials, money's money. And once the narrative is out there where something gets tied to climate change or tied to clean energy, right, it'll go up in price. So once we tie fertilizer to clean energy and the price is already going up, or once we tie zinc and copper to clean energy, the price goes up. The narratives that win all derive from what's right here. Everything that's in the ARC Innovation Fund, everything that they talk about, that's what's going to win forever. And then a handful of things tied to inflation and resources, right? And remember, when you look at real estate, don't look at the rents. Not right away. Look at the asset. Consider what the CapEx is going to be on that asset over time. How easy is it for it to move from one tenant to another tenant? What type of remodeling has to be done? How much would it cost? When we take a look at something like Simon Property, right? I'm just laying the seeds for next week because we are going to have the REITs ready by next week. Simon Property had to buy JCPenney so they would have an anchor tenant. They failed to buy it the first time. And I was glad about that because I think JCPenney is toast. I asked my girlfriend, I asked a couple other people, what would it take for JCPenney to be popular again? And none of them could tell me. How does JCPenney ever become popular again? If it does, that means Sears is coming back. So I think that Simon Property made a huge mistake buying JCPenney. The only thing it has going for it on that is that it was pretty cheap. But what they should have done is gone to Amazon and said, hey, how about you put Whole Foods in all of our freaking malls and maybe a distribution center too, or some way of having food delivery out of these places. Let's build this out. Do Whole Foods superstore distribution centers for Amazon Fresh. So somebody asked, aren't millennials momentum investors? A little bit. So what? Tell me why. Why does that matter? Why is that bad? Don't you want to ride trends up? Don't you want to invest in things that go up in price? If you can get growth for a fair price or a value price once in a while, isn't that what you want? Don't you want the things that go up? I think they'll buy AT&T, and I think somebody else is going to buy CenturyLink. How's that for an answer? We don't need the millennials to buy CenturyLink, right? Because somebody else is going to do it for us. And then they're just going to be an enterprise company. And that might be exciting. Enterprise and fiber. That's why they did the restructuring at Lumen, formerly CenturyLink. And AT&T, strategic transaction, right? I don't think they will pay any amount for Amazon or anything like that. They won't. I'm telling you, get every perception you have of the millennials out of your head and study what they're saying and doing. If you actually study what the millennials say and do, and you can get over the emotional imbalances that they seem to have, and maybe you go back and say, you know, maybe they are a lot more like that World War II generation than we thought. Maybe they just do what they need to do, and they shut up the rest and shut up about it. I mean, I take a look at the millennials that I know, all the guys I played baseball with, all the ones that I know through poker, all the ones through my kids, nursing school, business owners, sales managers already, doctors, lawyers, PAs, tech, all kinds of tech people. Yeah, you've got that 500,000 millennial men who just will never work because their moms let them not work. The rest of them, and especially the women, I don't know, man. They're taking over fast. You better respect it. They're the biggest generation, and they're going to have more money than anybody. If you take a look at where the lines are going to cross, they're going to have the most money sometime in the 2030s. So, you know, one thing to remember about AT&T is they're paying you a fat dividend to wait for some sort of strategic transaction. Beats the hell out of a 10-year or 30-year bond. I mean, I wouldn't make it more than 2 or 3% position, but if you are a retiree dividend investor, you know, it's kind of hard not to like that dividend, right? 7.34%. Where else are you getting that money? This is an essential service. AT&T can't disappear, and they have an asset that is worth their entire debt. I'm telling you, if they spin off Warner Brothers, if Apple comes to them and says, "Hey, let's buy that. Let's figure this out." You know, Apple could come to AT&T and say, "Let's really do something strategic. We'll pay you partial cash and partial Apple shares." And all of a sudden, AT&T has Apple shares instead of Warner Brothers, and they don't have to put any CapEx into the Warner Brothers, and they pay off a giant hunk of their debt. It's just cash flow because they're going to get the Apple dividend that's rising. There's a lot of things that can happen with Warner Brothers. It's a super valuable asset, and the way that entertainment is going, libraries of content that go back decades are hugely valuable. You saw what Disney did today, right? Disney reorganized around their streaming business and their content. There you go. Where does Gen X stand? Dude, you know, nobody pays attention to us. They didn't make us dinner at night. Well, my parents did. But right, they weren't there waiting for us when we got home from school. Here's the key, kid. Go take care of yourself. It's never going to change for us. Nobody's going to listen to the Xers until one's president, and that'll be a fleeting moment because it'll just be a stepping stone for a millennial to be president, right? We might, I don't know, is Kamala Harris a boomer or is she an Xer? I think Kamala Harris is an Xer. So there you go. There's your first Xer president, as be my guess. All right. Now, by the way, on SunPower, if Trump does somehow win, yeah, he probably should sell it, at least for a little while. But everything that I'm reading, everything that I look at, the guys out east are telling me they're already all preparing for the Biden presidency. And they would love to see the market drop 20% real quick. So if you have big money that wants to see the market drop 20%, and you got the millennials who are playing with options, if nothing else, they can just blow up their calls, right? What if the millennials, even if they don't do it ahead of time, start buying puts after the decline is already in place? Do they turn a 20% drop into 40? I don't know. But there's an awful lot of room down here and almost no room left up here. Today, today's rise was pretty dramatic. Nah, I haven't read Avi. I haven't read Avi in months. Today's rise was pretty dramatic. Unless the Fed decides it wants to pump things up through this line, it ain't getting through this line because the fiscal stimulus just don't matter. Not to this. Remember, the fiscal money comes in over a long period of time. The Fed can come with a bazooka and blow through there if they want, but then they'd be destroying the dollar. Oh, the one thing about UBS basically said Biden's bad for the dollar. That's just so ass backwards it blows my mind. They said the same thing back in 2012 and 13 when I said that there was going to be a dollar rally and we got the 10-year dollar rally or whatever it was, 9-year dollar rally. Biden's way better for the dollar than Trump. Way better. So I think UBS has got their panties in a bunch right now. A bunch of Austrian economists who don't know what they're talking about. Trump's not going to win. Avi said that Trump was going to win. Yeah, he's full of shit. Did he say he's going to win the vote or is he just going to like have a coup? Oh, yeah, he's full of shit. Avi is a pretty good technical analyst. He's not doing any. They're actually not, other than drawing pretty waves that can go up or down. I mean, these Fibonacci lines and then these 4 indicators. That's all you need. That's all you need. You just look at the daily, the weekly, the monthly. It's just as effective. And what have I told you about people who basically are technical analysts and say they don't care about fundamentals? Don't fucking listen to them when they talk about fundamentals. They don't know what they're talking about. And I'll tell Avi that to his face. I've met the guy. He is the sweetest guy in the world. But I don't think he's right about a lot of the fundamentals. Just like I don't think the crypto people are right about crypto anarchy. And I don't think the Austrians are right about business cycles. They're all wrong. They're all wrong. Anybody who doesn't basically gravitate to Keynes because he's been right for 100 freaking years is missing what's going on. And now I know that a lot of people say, Keynes this or Keynes that. Well, we haven't really done Keynes in a long time. Because remember, Keynes said pay down your debt when things are good. So we'll see. Yeah. The reality is that you can stimulate the stock market with deficit spending or by growing the economy from the middle out. This was always unsustainable. It was always unsustainable to have the line start going up this dramatically. It was always unsustainable. We've known it was unsustainable. I've shown you the valuations. I can tell you what's going to happen. I just can't tell you exactly when. But now that we're close to this line here, without the Federal Reserve pushing us through, it ain't going to happen. It ain't going to happen. And you're going to get your chance. I don't know if the chance is going to be on this line or around here or in somewhere in here or here or here. But it's going to come down somewhere in here, and you want to be a buyer. And that's why I think you buy incrementally, because ultimately, you know, it's 4 years later, the market should be 30% higher. You know, anything below this yellow line is there's a reasonable argument for it. We know this is overvalued. We know this is undervalued. The real price is in here somewhere. And we generally go through the real price because we get emotional one way or the other, either greedy or fearful. I think that's a good spot to stop. All right, have a great night.